Welcome and thanks for joining us for the October real estate and mortgage market updates and predictions for the Greater Toronto Area. My name is Jeff Thomas. I'm a real estate sales representative and will focus on the real estate market side. And my good friend and colleague Sebastien Fournier will focus on the mortgage side. So sit back and enjoy. So the agenda for today, we're going to start with some news updates, provide you with a wider context of what's going on in the market. And then we'll jump into some national updates from the Canadian Mortgage and Housing Corporation, the CMHC. And then we'll get more granular with some specific local updates and mortgage updates that would apply to you specifically. And then of course we'll provide our thoughts on the future. Although we don't have a crystal ball, based on what we know now, we'll provide our estimates and predictions what we think is going to happen before ending with some closing thoughts. So there is always a ton of news and reporting on the market, but I found these 4 articles were pretty good at capturing the updates best. So let's provide you with a brief update of these. So just starting here, the top one is the CMHC article. So this one discusses more, we'll get into more in the next slide, but this is a quarterly assessment by the CMHC that looks at the overall housing market in Canada. So this has been quoted by pretty much every mainstream news station in talking about how the Canadian market is quite hot and how it's keeping younger and less affluent home buyers out of the market. So we'll get a little more into those details in the next slide. This next one here is from Bloomberg, BNN, and it's good to talk about who's actually buying these houses. And there's been a lot of spoke on that in the news. So, and this clearly points out that the people mostly piling into this are people who already own a home or investors. In some cases, these people own 3, 4, even more homes. So in the past 12 months leading up to June, the number of people adding an additional mortgage more than doubled the increase for people who are doing it first time. And going up here, the next article here talks about mortgages, which again we'll discuss more in future slides. But generally this article, what it was talking about was a growing number of lenders, as you've noticed, already started increasing their rates in response to rising bonds. And lastly, here is an article which didn't get as much media play, but is more now. It's just that when you look at all the developed G7 countries, Canada has basically been above them all. So for the last year, for the second quarter, 2021, it was at a whopping 25.6% increase year over year. To put that in perspective, the rest of the G7 nations, excluding Canada, the average was only 5.5. The closest coming in second was the UK at 9.2, while our neighbor south, the US, was only at 7.8. Let's jump into the national updates for Canada. So I'm just going to highlight a few of the local city changes just by going over the different columns. So let's start with the overheating column. So according to CMHC, they added concerns that certain markets are overheating, specifically in the Victoria, Winnipeg, and Toronto area. So Victoria really shouldn't be a surprise, and Winnipeg was a bit of a surprise for me personally. I'm not too familiar with the Winnipeg market, but and Toronto, this was a surprise to some people in the fact that why Toronto wasn't already yellow. And the reason the CMHC indicated they didn't have Toronto as yellow prior, even though it's been hot for the past decade, is because the higher level of paying professional and tech jobs and the higher demand for the city made sense prior. But for right now, they're not seeing the reason why it should be increasing based on fundamentals. And again, this can likely be skewed by investors trying to get into the market in the Toronto area. In terms of the next column here, is price acceleration. So in terms of price acceleration, again, Victoria and Vancouver, which weren't prior typically hot markets, they have been added as well in terms of a moderate vulnerability risk, in terms of why they've been added and why they keep increasing. In terms of overall valuation, this one might be a surprise to a lot of people, but this has been pretty stable, except for Moncton. Moncton, for quarter over quarter, has been fundamentally only overvalued major urban center nationally. So again, just if you take a look, these are the major urban centers for the different provinces. It doesn't get into the smaller towns, but Moncton has consistently been the only one where they've consistently said, hey, this city is overvalued based on the fundamentals in the area. In terms of excess inventory, so this again has been pretty stable across the country in all the major markets. There was a bit of a downturn initially when COVID hit a year ago, but since the fall of last year, the inventory has been pretty much, it hasn't been sitting around for very long. So now in terms of the last column here in market vulnerabilities, so I just want to highlight, so this is the basic ones I want to highlight. One is Montreal, here at the bottom. So Montreal is a great city, has a lovely European feel. So this one has now moved from a moderate risk to a high risk. And that, as well as some overheating in some other markets and some smaller areas, has led to Canada overall, from CMHC point of view, being at a high risk of vulnerability. So again, this doesn't necessarily mean that prices are going to fall all of a sudden, but it does mean that the seller's market is spreading beyond the typical urban centers and above the fundamentals that they had seen over last years are not increasing in line with the prices and demand. So let's jump now into the local Toronto area. So what have we seen in the Toronto area? So what I'm going to do at this point is just provide here a 50-year history. So as you can see, over 1975 up to today, it's been more or less a steady increase with one bump around the 90s, which I'll get into. So the long-term upward trend has been pretty similar to the stock market, and it may be good to look at them overlap in future presentation. But for this one, I'm just going to highlight 5 points I think are good for an investor to know and understand to give you insight into what's going on in the market. So the first bubble here is a big one in the 90s. So 90s was the big housing bubble in Toronto area. And this is where most of you under 30 may not recall, but basically, as you can see, after the peak, it basically took several years for the market to start increasing again, and over a decade for the prices to get back to where they were before the bubble. So again, for most of you, that might seem insane to take a decade to get back, but that's what happened in the 90s. The next big event here, number 2, was the 2001 dot-com bubble, the dot-com crash. Again, this had a huge impact on most global nations, developed nations, but as you can see, relative to Canadians' housing market, really didn't, it just kept upwards on its nice steady increase. Point number 3, most of you should be familiar with this, listening to this. This is the 2007 US Wall Street and housing market crash. Again, there was a bit of a plateau there for a year, but then the Canadian market, there was no big drop. It just continued on its steady increase year after year. So that steady increases occurred until point number 4, where there was this big bump and then a little decline again. So that relates to, in 2017, 2 things happened. First is the stricter mortgage rules. So a lot of buyers, especially first-time buyers, are trying to get into the market before the rules got stricter and decreased their buying power. And the second, which had a bigger impact in my opinion, was a foreign buyer tax in the GTA, where we followed what was already done in British Columbia, where in their major urban centers of Vancouver, they had a foreign buyer tax, or anyone who wasn't a permanent resident, we charged a 15% tax above what they buy. So this led to a mad rush of people, I believe it was an April deadline, to get in and buy before they charged a 15% tax. So again, once that hit and once the rule came in, you can see there was a drop in prices. So that sort of led us to 4. So after that, that's sort of where things sat. Things were sort of quiet for the years following the foreign buyer law. Things had calmed down a bit until something happened last year, which we're all familiar with now as the COVID bubble. So basically what happened is COVID-19, a lot of people sort of were at home, so they did have extra cash from not spending and traveling. And there were a lot of people who wanted to move out of the city. So in jump with that, it led to one of the biggest increases ever in the Toronto area, the Greater Toronto area, as people were moving outside of the city and they were moving to smaller areas, which had huge increases. And then again, they were upsizing. The people in Toronto did upsize as well, because now they had extra money and they just wanted more space. So the condo market took a bit of a hit, but the detached houses, 70 detaches, especially outside the city, had a huge increase. So one tip I want to leave you with before we get into more local updates is don't try and time the market. So if you look at local updates, 2 things I want to point out. The blue is for 2021 and the goldish color is the blue is 2020 and the gold is 2021. So I'm going to just start going over the blue lines for 2020. And as you can see, sort of the sales and new listings sort of have been going in sync in terms of a lot of the new listings have been snatched up lately. So as you can see here in April, there was a huge decline in new listings. Again, that was sort of the COVID, the lockdowns were sort of in full effect. It was a low point. And then in May, it started opening up, and then in June, it opened up more. So by June, there was some pent-up demand, not only from sellers and buyers, so there was a lot of properties that came on the market in June and July, and as you can see, the sales sort of matched that. So we had sort of huge increase in sales. that continued. And then if we look at the gold lines for 2021, so after the winter lull, for December and January, huge spike in both sales and listings, leading to a March high. So from the March high for both sales and listings, it has been decreasing a bit in terms of sales and new listings, because again, when you had such a huge amount of buying and sales activity, there's just less in the market in general. And then so it has been decreasing slowly, but prices haven't. So prices have sort of kept increasing and stabilized. But as you can see, the lower supply and the lower sales it makes sense. When you had 2 quarters of crazy near, historic sales and stuff that pretty much equal the prior 2 years, it would only make sense that there'd be less of a market now in terms of sales and listings. So moving to the next slide, looking a little more at the 416, which is the Toronto core here, the 416, versus the 905, which is this area outside the Toronto. Just one thing I want to point out. So you hear sort of the big generic figures like, hey, there was an 18.3% increase year over year. The average home price in Toronto is now about 1.14 million, right? So what does that mean sort of more specifically? Well, as you can see, most of that was in detached homes, right? So condos, yeah, they did increase, but they took a bit of a hit. Townhouses, it didn't increase as fastly, and semi-detaches increased a bit, but it was mainly detached houses. So that's where the most people wanted to be. So they had the biggest increases both inside Toronto and outside Toronto. But as you can see, the 905 area, or this area outside Toronto, had a huge increase, like nearly 50% higher than the Toronto increases, was that push of people getting outside the city. So we're going to dive this more into the bit on the next slide. So this slide is a little busy, so I'm going to leave on for a minute. But what this slide does is it breaks up everything nicely. So at the top, you can see the housing type. Because again, a composite or overall number doesn't provide enough context to really make sense. But this breaks it up into single family detached, single family attached or semi-detached homes, townhouses, and then condo apartments. So it breaks it up into the 4 groupings, and then these are the different areas within the GTA. So I'm basically going to just break through, and 3 things I want to point out to you here at the city level is just the yellow highlights. So the yellow, what I was trying to highlight here was sort of the yellow cities and the yellow prices. So basically, yellow represents areas or housing categories that are relatively lower priced than the surrounding areas. So for instance, here, if you look at Burlington and Halton Hills, they're relatively, better priced and lower increases in the Halton region, as well as Milton, than Oakville, right? So, and then if you look at townhouses here as well, you can look at Halton and Milton. They're relatively lower price in the Halton region than Burlington and Oakville. So it's just sort of, hey, if you like a certain area, whether it be Halton or Peel or York Region or Durham, what are the areas within that that is sort of lower priced, right? Now again, there's a reason some of these areas were lower priced and are lower priced. Generally, they don't have a lot of amenities. The access to the urban centers aren't as easy, and they're just not as gentrified or built up, right? So that's why they were cheaper, and that's why they still are relatively cheaper. Now, in terms of green, so Mississauga, Toronto, Vaughan, and Orangeville, so the green I highlighted, and these represent places that had the relatively lower increase over the last year. So this is primarily because the places I highlight in green, they were already developed, high demand, built up, and then the surrounding areas. So again, this might be an overall better investment decision in my opinion, as they're less inflated overall over the last years in places that had, a 30 or some places even like near a 40% increase in prices. So as you can see, like if you look at Durham here, some of the places had a 35, 30 increase, whereas some of these places in, York Region like Vaughan only had a 20% increase, or Toronto only had a 14% increase in detached. So although the prices there were inflated, if you believe there is a bit of a bubble, then these areas are highlighted in green, Mississauga, Toronto, Vaughan, and Orangeville. They're actually sort of your best option if you believe a bit, because as things continue to reopen up, and especially the urban centers start to open up, we do sense there will be more of an increase of the people wanting to move back into Toronto, and the 2 centers that are most around Toronto, Vaughan and Mississauga, directly attached. So, and just as mentioned earlier though, if you are looking to get into the market now, don't think you're going to come in right now for a short-term flip, but be ready to hold on, invest for at least a 3 to 5 year period, as things already did have a run up. So I know everyone always says, hey, buy, 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 it's our job to sell, but just as a word, don't expect a short-term flip right now. And now I'm going to pass it over to Seb for some mortgage highlights.
Thank you, Jeff. So first, it's important to note that fixed mortgage rates and variable mortgage rates follow two different underlying indicators. So we're going to start with the fixed mortgage rates that follow the Canadian bond yields. So you can see here on the chart, this Canadian bond yield chart that shows three important jumps. The first one, early 2020, was really the COVID pandemic onset that started and everything dropped. The second one, which is the first positive jump, it was early 2021 when vaccines were available to the public and started to be available for everyone. And the last one, which just started last month in September, it's really the beginning of the reopening of the economy. Travels, immigration restarted, eating inside restaurants, health passports are coming out, and school reopening. So this last jump of the 5 Canadian bond yield led many banks to start increasing their fixed rate by up to 0.25%, which is 25 basis points for people that are more in the financial sector. So we're trying to really see those increasing. Now, if we move at the variable side of things, you will see that this is, by the way, it's governed by the Bank of Canada, and it's the overnight rate. And as you can see from the chart here, the behavior is quite different from the Canadian bond yields. As well, the large drop, as always, when COVID hit, early 2020, but you can see it remained at 0.25% ever since, and it's been like that for the past 19 months. At the latest announcement on September 8th by the Bank of Canada, they kept the overnight rate the same. So what does it mean for buyers? Well, there's now quite a large gap between fixed mortgage rates and variable mortgage rates. And despite knowing that variable rates can only go up, by the way, as an aside, the Bank of Canada did guarantee that they will not drop the rate any lower, so it can only go up moving forward. Buyers now can have either the choice to get a variable rate in the low 1% or a 5-year fixed rate in the low 2%. So what my clients tend to choose usually depends on the type of property they purchase. If it's a rental versus owner-occupied, there's different reasons for one or the other, and how comfortable they are with a variable rate that will be increasing at some point in the near future to a level that no one knows. And so in other words, some buyers are willing to pay a premium for certainty and others are not. So it really depends on your own situation. Now, one interesting indicator that the Bank of Canada looks at very carefully is the job sector, and they've always claimed that they will not raise the overnight rates until the economy and the jobs have fully recovered from the losses that incurred due to the pandemic. So on the chart on the left, you can actually see that all job loss due to the pandemic have now been fully recovered since September. And also on the right chart, you can see that the sectors where remote work has been widespread, which is professional, scientific, technical services, public administration, finance, insurance, and of course real estate, I've all seen a gain in net employment. So they're up to 10% higher than the levels they were at pre-COVID. However, in the high-touch sectors, where they were deemed non-essential, the jobs recovery has been a lot more constrained. And then you can see that on the top left corner of that chart, where especially in agriculture, accommodation, food services, and recreation, where things haven't recovered quite yet. So one thing to note is that employment will need to surpass pre-pandemic levels before complete recovery is declared, because the population has grown since the start of the COVID-19 crisis, and the government wants to make sure that we are past those levels. So lastly, I'd like to talk about the stress test. You may have heard that it went up from 4.79% to 5.25% this past June. And I just wanted to show a table here that shows that what was the impact on buyers. So depending on your purchase price, the increase is responsible for 4 to 5% reduction in your purchasing power. I haven't really observed much impact on this stress test in terms of taming the hot real estate market, but it has led to more of my clients, especially first-time buyers, to rely on their parents to provide them with a gift to help with the purchase. So moving forward, what's important that the Bank of Canada mentioned is that this qualifying rate will be reviewed at the minimum annually every December. So it's something to keep an eye on in case it's going to increase further. So in terms of prediction and forecast, as I mentioned, the Bank of Canada does plan on increasing the rate in 2022. We don't know yet when, but it will be when the economy has fully recovered. That will increase variable mortgage rates for sure. In the grand scheme of things, interest rates are still very low though. So with the large increase of equity that Jeff mentioned with the increase in prices, a lot of homeowners have realized a lot of equity, and many will likely look at refinancing their current mortgage and investing the equity into a rental purchase and becoming a landlord. And lastly, I'd like to mention something that hasn't shown yet, but we expected to see an increase in CMHC insured mortgages cutoff. So if you're aware, basically CMHC insures all mortgages as long as the property purchase price is $1 million, is less than $1 million. With the new government, the campaign promises they made, the Trudeau government said that they would increase that to 1.25 million. So what would that mean for you or first-time buyers? It would mean that up to 1.25 million, you would be able to only put 5% down instead of having to put 20% down. So that would have a huge impact on the affordability for first-time home buyers. So that's it to me, and back to you, Jeff.
So what's my predictions and forecasts for home sales and prices? Well, I sense it's going to continue to be a seller's market. There's no real reason for that to change. I don't see that changing unless something comes along, which would typically, from this point, be legislation or, as you mentioned, interest rates or jobs, some of the big factors, but don't see any of those changing. I do expect this to be the third best year ever on record for GTA sales. Also expecting a plateau in prices. So again, not a decrease, but a plateau. So like a slowing increase in prices for the semi-detached and detached homes, especially in the less urban areas, as most of the people who wanted to move there already have. On the flip side though, I am expecting a resurgence in the condo market, and as first-time buyers priced out of the detached homes look to buy, as well as those returning to city life, workers and students, they're all going to be helping the condo market in urban centers. And lastly, as we move into winter, just expect things to go back to regular sort of pre-COVID seasonal sale figures. So not prices again, but just the seasonal sale figures in terms of listings and sales. So some closing thoughts. Again, the point of us doing this, we want to make it valuable for you. So any comments or feedback you have are always appreciated. And if there's anything you'd like us to cover in more detail or more specifically, please post a comment to let us know. And if you did ask some questions on real estate, mortgage, finances, etc., or assistance, please feel free to post a question or contact either of us directly. And of course, if you did find any of this interesting or helpful, please do hit the like button and hit subscribe. And we look forward to helping you with anything you have. So again, thank you again for your time. Have a great day.
Thank you, everyone.